Good morning, everyone. Thank you for being here and joining us. I'm Ali Najat Malayeri. I'm a finance professor at the University of Wyoming. I've got the distinct pleasure of being the moderator for our panel discussion today on the stablecoins, the state of affairs. Obviously, stablecoins have become one of the hottest topics in the financial world and the blockchain world last year. I'm delighted to be joined by a fantastic group of guests here with me. And I'm going to start with asking them to make an introduction. First off, Caroline Hill from the force behind second largest stablecoin, Circle. Caroline, if you would, make an introduction, tell us a little bit about yourself, how you got into this gig.
Sure, happily. So Caroline Hill, great to talk with you all today again. I'm the director for global policy at Circle, and I actually came to Circle from the U.S. Treasury Department, where I was for almost 8 years. And at the Treasury Department, I was focused on illicit finance risk, which is partly why I spent so much time on that earlier. And my last job at Treasury was overseeing a team that covered Africa and the Western Hemisphere. And I saw how developing countries were incorporating financial technology for their own uses. I also saw how this was being abused by illicit actors. But I really saw the firsthand effects of developing countries without access to financial services, without correspondent banking relationships, without consumers, without bank accounts, without access to credit, et cetera. And I could see immediately the transformative effects that digital assets and stablecoins specifically could have on these in these countries for unbanked and underbanked persons, which led me to Circle and to Zurich here today. So thanks for having me.
Thank you. Fantastic. So she is living the dream and walking the walk. With that, I get to Kai Bouchardy from BCG. So Kai, how did you get from the consulting world to blockchain and all of this?
Yeah, thank you for having me. Kai Bouchardy, Managing Director with BCG, and they're the technology arm of it. I started tapping into blockchain 2015. We had a first strategy project with a clearing and settlement house in North America, and try to help them understand not to lose line of sight compared to what happened in the internet time. This time with blockchain, they should be on top of it. That's where I started, and since then continued in this journey from general technology blockchain to broader chains, to different use cases, supply chain, and so on. My second leg is always technology and banking, so I combined the two quite a bit. And in 2018, we had the first project analyzing a CBDC platform. And the big debate was, should it be on DLT, blockchain, or traditional, in order to help people getting it off the rails. Since then, a lot of things have evolved. We set up what's called CBDC tracker for everything what happens in the CBDC world, cbdctracker.org. We update the data of this tracker pretty much every week, so it's a pretty accurate scene and an overview what's happening in the world on CBDC. And we recently published and announced a consortium on CBDC as Project New Era at Money 2020. So we're building up currently a consortium for setting up a synthetic CBDC in UK.
Thank you. Fantastic. So as you can see, a stablecoin expert, a CDBC expert, and not the least, we have Bruno Playo via Zoom with us, the architect behind the JET algorithmic stablecoin. Bruno, if you could tell us about your experience, how you came about to creating an algorithmic stablecoin and how things are going.
Hi, yeah, thanks for inviting me, Ali. So before I start, can everyone hear me and see me well enough? Yeah. Okay, great. Yeah, so Ali, I would say that my interest in financial stability goes back to the global financial crisis of 2008. I was personally affected by it, and it gradually became a personal mission to work on projects that would promote not only financial stability, but also transparency, inclusion, and fairness. So this brought me to the cryptocurrency industry, but I was immediately a bit disappointed, with the volatility that existed, right? Because if we want to make cryptocurrencies that are really currencies, right, we need stability, right? All the functions of money need stability. So when I started working full-time in the cryptocurrency industry back in 2017, my first project was to design a feature for the Cardano blockchain that would allow anyone to create new native assets on the Cardano blockchain with their own monetary policies. And my most recent project is the JET stablecoin protocol. We have spent 2 years in research and development of this protocol. What is interesting about this algorithmic stablecoin is that it is fully backed, and it is formally verified. So we have proven mathematical theorems that it is stable. And we have verified these theorems using automated reasoning tools. We have also some empirical validation. So there is a live implementation running on the Ergo blockchain for 1.5 years already, and it has never traded below the peg, despite all the multiple market crashes that we had. And now I'm founding the JET Alliance to make deployments of this new algorithmic stablecoin on other blockchains as well. So yeah, that's my introduction, Ali. Back to you.
Thank you. So as I said, again, a great panel of experts who've been in thick of things, obviously very passionate about what they do, which sets the stage up greatly for the loaded questions I'm about to ask. This year, April is going to go down in infamy as the month that a lot of things happen in the stablecoin world, and some of the great celebrated projects failed. And hopefully we have learned enough to know what was the root cause of it and what potentially could be the solutions. So with that, Caroline, if you don't mind, could you give us a rundown of what these events were, especially vis-a-vis USDC, and how do you think it has changed the regulatory landscape and what we're facing and where we're going as you look forward?
Yeah, absolutely. The events of April, well, I'm sure one of us could give, several multi-hour-long lecture around what happened in April. But essentially, we saw, an algorithmic stablecoin that was not stable, lose value almost overnight, and begin trading, at several cents on the dollar, which caused several ripple-on effects. Although, as we were talking about at the break, could have been, could have had much larger market effects, but certainly caused an, incredible loss of value. Terra Luna alone lost 50 billion, 40 billion in value overnight. And, we've seen a few lenders have knock-on effects from that. The regulatory environment in the United States and the UK and the EU was already seized by the need to regulate stablecoins prior to April events. I think this certainly spurred the continued focus on it. I think in the United States, particularly, regulators have first started focusing on stablecoins because it's sort of the easiest thing to focus on first. EU has obviously taken a very different approach with MiCA, which is to say we're going to look at all things digital assets. And we're even, hearing about MiCA 2.0, which will cover DeFi and NFTs. And so there'll be several rounds of regulation coming out of the EU. But the United States said, let's narrowly look at stablecoins and actually narrowly look at fiat-backed stablecoins as a first step in regulation, prudential regulation around it. As I mentioned before, AML regulation is further along, but we don't have that in prudential regulation. the UK then also this spring that had been a little quieter and a little further behind on regulation said, well, we're gonna have our own regulatory standards here in the UK. And so they're moving forward with that as well, kind of government issues aside when they have a new government in place. So, again, I think that the consensus from April was that we need to continue with these efforts, but they were well underway already. And I think, whether or not they'll, again, like in the United States, include algorithmic stablecoins or not, remains to be seen.
Thank you. Thank you. Fantastic. So, that actually brings me to the next question. We had a talk from a central banker, and it seemed like the central bankers are still on a cusp of whether CBDCs are a good idea, especially for retail investors. However, in a recent paper, as Kai mentioned, Get Ready for the Future of Money, it seemed like your group recommends that CBDC is a great idea and stable coins stand next to it. So could you elaborate on that?
Sure. So the paper you refer to is roughly 2 years old. Luckily, everyone's idea and thought process have evolved over that. But in that paper, we are describing a bit the different forms of digital money, from e-money to stable coins, 1.0 stable coins, which are actually social stable coins, CBDC in a very purest form, and also we invented back in the day a CBDC 2.0, which is actually a very provocative setup, which is there are more people, more companies, more stakeholders involved than only central bankers in order to make right decisions and interest rates, remuneration, and all the good stuff. So it's much more an inclusive way how to do financial or the regulation of financial the financial remuneration part in a dedicated country. So that was back in the day of this paper. Nowadays, I think what we saw that first, about 90% of central banks are researching about CBDCs in general overall. The majority of that one is actually looking into retail CBDC, and the conclusion for many of them is we go for a two-tier model, meaning the central bank is issuing, but the distribution side of the wallet of the CBDC coin is actually happening via the normal financial institutions. The reason for that one is they don't want to disrupt the current financial sector, therefore they need a role in there. On the other side, you have one fundamental challenge with CBDCs, which are in the purest form legal tender, and that means you cannot get any loans against that one. So if you have a situation where you put a lot of deposits and move deposits to a CBDC, banks would not have any possibility or significantly lower possibility to hand out loans, and therefore you have a credit challenge in your economy. That's why we currently see that stablecoins and CBDCs in a boundaried setup will stay in combination, so next to each other. We do see that you can have at least similar functionality elements like programmability as well, but also you have different means of what am I using it, right? You have on the one hand side in the stablecoin still an issuer risk in that, versus obviously in the CBD side we don't have that one. So there are a couple of differences, and therefore their purpose for one as well as for the other. And in our fundamental belief, CBDC will come. It's not a question of if, it's more a question of when. I would agree with, I don't know anymore which of the speakers have said that. So I see also it will take another 3 to 5 years till, let's say, we see CBDCs at scale at least.
Thank you. Thank you. Very interesting. So, it seems like at least we're forgetting, if not bashing, the algorithmic ones. Bruno, I guess it's fair to ask a question about the algorithmic stable coins. Where do you think the frontiers are? How do you think they're evolving, or how do you think they should evolve? And what are the things that, we're missing? What are the advantages that an algorithmic can bring that, the other stable coins can't, or for that matter, CDBCs can't?
Okay. Yeah, there are many questions there. I hope I will be able to answer all of them, Ali. So, yeah, first, I think it's important to understand, from what we have seen with Terra, it's important to understand that there are many different types of algorithmic stable coins out there, right? And they're not all the same. I think that sometimes people think that algorithmic stable coins are necessarily backed by nothing or collateralized by nothing, right? There's this conflation of concepts, right? Of being algorithmic and being unbacked, uncollateralized. And while it's true for some algorithmic stable coins that they are unbacked and uncollateralized, this is not true for all stable coins, right? For all algorithmic stable coins. Being algorithmic just means that the stable coin operates according to a set of rules encoded in a smart contract. And there can be good algorithms and there can be bad algorithms, right? In the case of Terra, it's based on an algorithm that I would consider a variation of the seigniorage shares model, which is an algorithm that goes back to 2014, and it has some issues. The stablecoin had no backing. There was a seigniorage share token, right, the Luna, but it's a mistake to think that Luna is backing the stablecoin, right? Because Luna is only valuable if the stablecoin has demand. So yeah, Luna failed, but there were many algorithmic stablecoins out there that survived the crash fine. Like one example is DAI, right, which is fully collateralized. Another example is the JED stablecoin, which is fully backed, the one that I designed. Yeah. So I think I answered some of your questions, Ali, but not all of them. You asked also about interaction with CBDCs, right? So regarding CBDCs, I think one of the use cases of stablecoins is to make a digital asset that is pegged to the US dollar, to make such a digital asset available to smart contracts that exist on public permissionless blockchains, right? So as long as the BTCs exist, in a separate permissioned DLT, stablecoins will continue to exist, to fulfill this demand for a USD-backed stablecoin to interact with decentralized finance protocols on public permissionless blockchains. Now, if a CBDC were to be launched directly on a public permissionless blockchain, then of course there would be a reduction in demand for stable coins. Yeah.
Thank you. That's actually very fantastic, because I think it lets me to do a segue to some of the stuff that is probably a repetition for quite a lot of people here, in that I do believe that algorithmic stable coins have tremendous potential, and lumping them with the fiat back is a disservice to both of them. The separation would make life a whole lot easier from regulatory perspective, as well as from technological and financial innovation perspective. It frees both sides to basically pursue the life that they deserve to live, so to speak. But then again, I'm an academician. What do I know? So my question to the panel is that perspective. Am I being too naive? Is there some truth to it, or something that I'm missing here? And I'm going to start with Kai here. What's your perspective about my humble opinion?
As long as we can agree that we don't call it an algorithmic stable coin, but algorithmic coin, I'm 100% fine with that, right?
Okay.
What we currently have not seen in the market yet is a pure algorithmic stablecoin that can overcome a bank run in that sense. We have not seen that one. So therefore, currently, so far, it hasn't been invented. So in one way or the other, there is something either failing and or something else next to the algorithmic part. And that's very different. The moment it's very much more easy to set up a fiat-backed stablecoin because you actually know what you have to do. You have to get the audit. I mean, USDC is a prime example to that one. So that's relatively simple, and you can still use it in DeFi and so on. I found your speech very interesting, as long as we can agree that, okay, what you build then with an algorithmic piece is actually a derivative and nothing else, which can be used for certain elements and has potentially from financial engineering some purpose, and do some, hopefully also some good things. That's fine, but it's not a stablecoin in the sense of store of value in means of exchange.
All right, fair enough. Caroline, what's your thoughts?
Could not agree more that it's not a stable coin to exchange value, to have stored value. But there are still purposes for it, as we've discussed. And I think that distinction in name and then definition will lead to the correct structure of a different regulatory structure around it. Algorithmic tokens should not be regulated in the same way that fiat-backed stablecoins should be regulated, just by the nature of how they're designed. I think regulators are very resistant to code audits and the like, as we talk about how to regulate over DeFi. But that's possibly where regulators would have to go when regulating algorithmic stablecoins, which is, let me dig into the code and see if this will withstand a bank run. Right now, the only way we know if an algorithmic token, can withstand a bank run is if they're in a bank run. And that's not a very feasible pathway moving forward if their market share were to grow. So some may say, well, that's semantics, call it whatever you want. But I think the nomenclature here is incredibly important, as it will lead to better regulation, which will lead to better financial stability in the market.
Thank you.
Maybe let me add one thing.
Sure.
That just came to my mind.
Of course.
You after 2008, you created central banks created and auditors created stress tests for banks, right?
Mm-hmm.
So what happens is a certain economical situation is occurring. What happens to your stability as a bank? You could set up these things similar to larger DeFi protocols on token providers and so on, in order to give transparency to what extent they are stable or less stable in their business model, right? That could be one example. They don't have to do it alone and on their own, but they have to give the framework for this, and then the companies or platform providers have to show how it will happen. Sure.
So what you're suggesting, in 20 years' time, if you don't have a double PhD in economics and computer science, you shouldn't be a central banker. So Bruno, yes. What are your thoughts about yours truly thoughts?
Yeah, okay. So I have a comment about bank runs and algorithmic stable coins, right? So I think, and this comment goes back to what you said, Ali, in your talk, that bank runs are possible when there's no backing, right? So when people talk about bank runs on algorithmic stablecoin, they usually have that view of algorithmic stablecoin as an algorithmic stablecoin that is unbacked. But if you have a fully backed and over-collateralized stablecoin, algorithmic stablecoin, then the bank run is not possible. You can have the liquidity issues that you mentioned in your talk, right? But not the bank run. You can eventually have the bank run if the backing asset that you have reduces in value, right?
Sure.
For such cases, in the JET stablecoin protocol, we reduce the possibility of a bank run by reducing, by gracefully losing the peg, and giving a fair share of the backing asset to all users, and not to the users who are coming to redeem the stablecoin first. Okay, so there's one comment that I had. Now, another comment about stablecoins as payment methods, right? So Yeah, on one hand, I agree with what has been said so far, if I look, for example, at Brazil, my home country, Brazil has an excellent payment method, the Pix. People can do instantaneous payments for free, easily. And I don't imagine that anyone would try to use a Brazilian real stablecoin to make transfers instead of using Pix, because that would be more cumbersome for people to do that, and they would have transaction fees on the blockchain and so on. So on one hand, I agree with that. On the other hand, I do see people making payments with stable coins. I myself make payments and receive payments in USDC and USDT regularly. And I think the reason for that has to do with cross-border payments. For cross-border payments, it's too much cheaper and much more convenient to make payments using such stable coins instead of trying to use the normal banking system, the normal payment systems. So let me see. I had another thing that I wanted to comment about. Which is stablecoins and synthetic cash, right? That you mentioned in your talk. So yeah, if by synthetic cash you mean synthetic money, then I completely agree with you. But when I think about cash, I think about physical cash, and I think about the properties of being fully peer-to-peer and anonymous, and for that to be possible, whether we're talking about stable coins or CBDCs, or any digital asset, for us to support peer-to-peer anonymous transactions, there are still many technical challenges to be solved, So yeah, I don't think stable coins or even CBDCs would become a synthetic digital cash in this sense, of providing this type of functionality that physical cash is providing to us. Yeah, thank you.
Thank you. I actually very much agree and I love your point about a graceful sort of a way of exit or resolution of conflict. I think I agree with that 100%, that time of crisis calls for the exact opposite of what the modus operandi usually is, which is a speedy, et cetera, et cetera. Time of crisis calls for something else. So I'm going to basically, then do a follow-up question, which is, and this would be my last. It seems to me one of the greatest things that the blockchain has offered is basically a way to get around a global effort to kill globalization. And blockchains do an exact opposite. And that brings the whole notion of cross-border payments, equal access to money, capital, et cetera, et cetera. How do you, and this is an open question for everyone in the panel, how important do you think that is to have a free-floating capital / ideas for betterment of humanity, for that matter, and empowering the pockets that have been, disenfranchised, per se, Africa and other places? Caroline, please.
Sure. It's the whole reason our company was started. I think what we're really seeing now is the democratization of financial services around the world, and that's what blockchain is bringing to people. Even in the United States, we like to think that everyone has the same access to the financial system, and they don't. Depending on where they were born or what they look like. And that's certainly the case around the world. Like I mentioned, my time covering Africa and the Western Hemisphere, and seeing everyone in the world having access to a smartphone, but can't take out a small business loan or send money to family in another country. Those aren't developing world problems. They're problems in developed countries as well. As we heard this morning from the SNB about the challenges that he has in banking here in Switzerland. I think this crypto winter, like I said, we'll kind of see companies survive and not, but the technology is here to stay. And what the future of it looks like, I think, is up to the people in this room, people listening in, the people in the industry. But it will certainly, I hope, provide access to millions, if not billions of people who don't have it right now.
Thank you. Kai?
I think you're going to differentiate it a bit in the sense of blockchain is providing exactly this functionality and opportunity to democratize access to money, sending or do cross-border payments at a very low cost. However, when we saw attempt from Facebook with Libra, DM, regulators and the more country perspective is going to be holding possible innovation quite a bit at hand. So I think these are exactly the two different forces which we will see. And therefore, for these elements, I see much more opportunities and possibilities on a stablecoin setup as a privately issued stablecoin than necessarily at the CBDC, which by design will be typically always more regulated and potentially at a certain moment in time being able to do real-time cross-border payments from one CBDC to another CBDC, but still it has many more hurdles to overcome from each and every country to actually issue something like this compared to, well, everyone in the world can actually have a USDC the moment you have access to internet. Right?
Thank you.
And therefore, it will be very different, but hopefully private innovation will help.
All right. And Bruno?
Yeah, you know, like goals like financial inclusion and democratization of financial access and stability. Of course, very important for me, as I already mentioned in the beginning, right? One thing that actually concerns me a little bit, you know, like for example, when working on, let's say, a USD-pegged stablecoin, is that this actually makes it a bit easier for USD to dominate and drive away other currencies elsewhere in the world, right? Yeah, and this can be a problem, right? Some reports related to stablecoins and CBDCs have already raised this issue, right? So it's because of this issue, well, not only because of this issue, but also because of this issue that with JED, you know, with the JED Alliance, we are not focusing here on a single stablecoin pegged to a single asset, but rather an alliance of multiple deployments. Yeah, so we, or at least I, believe very much in a multi-currency world, you know, in enabling people to create their own currencies with their own monetary policies. And of course, when we think about this potential multi-asset world, multi-currency world, there can be the problem of liquidity, right, for all these assets. But I think this is a problem that nowadays we have the technological tools, you know, to solve. If you look at what we have on blockchains nowadays with smart contracts, we have many liquidity pools, you know, that allow users to relatively easily swap one asset for another. And I think this kind of technology, you know, will allow us to live in a multi-asset world, in a multi-currency world more fairly without one currency dominating all the others, you know, whether it's Bitcoin or USD or Ethereum or any coin or even my own stable coins.
Thank you. Thank you. Thank you all. Right. I think we reached the point that everybody was waiting for, and that's questions from the audience. So please.
Hi, Luis. Thank you for all your contributions. I have a question maybe for Bruno, but I would like to get the feedback from the other ones as well. You mentioned PIX in Brazil, and that with the direct money flow, which I think is from Bank of Brazil, then there's not so much point of using for instance, the stable coins there, because except if it's for cross-border payments. So I would like to understand a little bit further, like if there was a big change regarding there was usage before and then they stopped using it, or how that impacts. So let's say, as Ali mentioned, in the future there will be CBDCs. So if there will be CBDCs, that will be basically the impact that we will probably be seeing elsewhere. I would like to get his take because it seems that you already saw it.
Okay.
Okay. Yeah, so just to clarify my point is that there wouldn't be so much of a, with something like PIX, there's not so much of a point of using a BRL pegged stable coin for payments between people. But there would still potentially be a use for a BRL pegged stable coin, to interoperate with smart contracts on a blockchain. So let's suppose that you have some decentralized finance protocols, on some public permissionless blockchain, and you want to invest Brazilian reais on that protocol. So for that, you need a BRL stable coin there, right? So I don't think that there will be a need for stable coins in this sense, unless the Central Bank of Brazil decides to issue a CBDC on all the public permissionless blockchains that we have out there. So I think even with perfect payment systems that are not stablecoin based, there would still be a need for stablecoin from the point of view of interoperability with public permissionless blockchains, right? Now, I think the other point of your question was whether there was use of BRL stablecoins before PIX and whether that reduced. Yeah. I wouldn't really know how to answer this question, but generally I think the market cap of stable coins that are not pegged to the USD tends to be very small, right? And often in countries like Brazil, or even more in countries like Argentina, the point of stable coins is often to have a digital asset that is pegged to a stronger currency like the USD or the euro, instead of the national currency, which tends to have higher inflation and other issues related to capital controls.
Thank you. Any comments from the panel?
I'd just like to respond to something that Bruno just referenced and referenced earlier, which is multi-currency fiat-backed stablecoins. I think that's right, and I think what is important about fiat-backed stablecoins is it's not actually creating any empty money supply, but it's simply reflecting money that's already in circulation, allowing central banks to continue to conduct monetary policy. Obviously, we've seen most fiat-backed stablecoins pegged to the US dollar now, and others kind of coming out and are still very small. But I think that will be incredibly important in the future. And I think maintaining the central bank's ability, in many of the major currencies around the world will be very important. And if central banks feel like they don't have that ability, then they'll probably more quickly and speedily turn to CBDCs to maintain that. But as Bruno mentioned, in places of high inflation, Ali, you mentioned Venezuela earlier, certainly a fiat-backed stablecoin for almost any other currency would be preferable. And we've actually, Circle has seen Venezuelans, we've worked to get USDC into Venezuela, both so that the Maduro regime can't steal wages coming in, and both as a hedge against inflation.
And I think, sort of add on to that, I think stable coins in general are the probably the friendliest gesture that the industry can make to central bankers, and that they maintain the ability to basically decide what they want to do, which affects inflation, et cetera, et cetera. However, they relinquish the issuance of digital money to the sponsors of the stable coins. So stable coin sponsors facilitate digital commerce without meddling into central banking operations. Now, you might not like that, but I think that's basically what it boils down to. Do we have a question from online?
Yes, I think Luis has a question. Maybe Luis, you can unmute yourself.
Thank you very much for the panel again. I'm very interested in a point that hasn't been touched very much. It's about the regulatory side of all the stable coins. And as we're seeing in these days, in fact, today was going to be passed a bill by the US Committee on Financial Services around this topic. And there are many global coordination movements around the regulatory aspects of stable coins. I mean, it looks like all the movements are converging towards only permitting the issuance of this type of money to depository institutions. I mean, at least that's what the US Treasury recommended. So another of the aspects is the Basel Committee on Banking Supervision also launched a paper on a few recommendations of how stable coins should be issued and which could be the limits, and they posted a few like a stable coin, a proper design stable coin shouldn't pass below 99.9 cents over more than 3 days during 12 months, or 99.8 cents for more than 10 times during a year. Those are tests that at this time, any stable coin, nor decentralized or centralized, are passing this test. So what do you think about all these like global movements on the regulatory side that where they're gonna end up?
Sure. Yeah. Great question. I'm happy to start. You know, you mentioned legislation that is potentially moving through Congress right now. It looks like it will be delayed several weeks to months to this fall, as negotiations are still going on. But a few themes have emerged between the EU and US for stablecoin regulation, which is fiat-backed stablecoins with full reserves in regulated financial institutions, with certain risk disclosures and audits, and transparency of those reserves held in high-quality liquid assets. MiCA also has a threshold limit for transactions daily that the US doesn't have. And then, of course, importantly, both regimes or proposed regimes continue to allow for banks and non-banks to issue stable coins, which is an important distinction that has been debated for quite some time. You know, as I mentioned, the United States has not yet taken the White House and Treasury authored report focused on fiat-backed stablecoins, and it's possible that the first legislation around stablecoins won't include algorithmic tokens, but will only focus on fiat-backed. That could change, of course, but that has certainly been what Treasury and the White House is focused on. So I think there are emerging themes. As I mentioned earlier, I think having some type of harmonization between jurisdictions is incredibly important to allow this innovation to continue to develop. If you have issuers that are needing to be licensed under bespoke regulatory regimes that are quite different, there won't be that broader market adoption that really allows this innovation to flourish in cross-border payments, et cetera.
Maybe one additional add-on. Sometimes there are still debates at the regulatory side to what extent you need to identify the sender and receiver in a stablecoin setup. Just practically, I have a very hard time thinking about how that could work, especially when you have a stablecoin in a permissionless public blockchain, because it can be anywhere in the world. But luckily, so far at least, it is still only a debate and not a decision yet. But I think some careful thinking is required as well.
Thank you. Bruno, any comments?
Yeah. So yeah, regarding regulations, I think that so far regulation has been focusing mostly on fiat-backed stablecoins, right? And this is understandable because they are the biggest ones in market cap. I think we're all in agreement here that there should be a distinction between fiat-backed stablecoins and algorithmic stablecoins, right? I would like to perhaps propose an analogy that might help to understand why I think this is important. You know, the point of algorithmic stablecoins is to try to make something that is completely autonomous, right? It's like a self-driving monetary policy. And if we make an analogy, for example, with self-driving cars, you know, we have an analogous regulatory problem there, right? Because, you know, driving cars is a regulated activity. You must have a license to drive a car. But then when you have a self-driving car, then what do? You know, it's clear that you need some kind of new regulations for self-driving car. You know, it's not enough to just demand the passengers to have a driver's license or to demand the company that built the self-driving car to have a driver's license. You know, it's clear that we need some regulations that would require the self-driving cars to comply with some rules, right? But it's not just a matter of trying to fit old regulations onto those self-driving cars. And with algorithmic stablecoins, it's a similar situation. You know, a fully algorithmic, fully autonomous stablecoin will be operating completely on its own on a blockchain. It will not be operated by any entity, right? And this will require different thoughts about how to regulate this type of stablecoin. And I'm a little bit concerned, you know, that the failure of Terra could have a negative regulatory impact on all algorithmic stablecoins. And I think this would not be good, you know, for our progress, you know, even like as a society, as a civilization, because if we think about how we progress, you know, it's usually by automating processes, right? And algorithmic stablecoins are precisely about automating monetary policies. And the potential benefits from a regulatory point of view can be quite significant, right? Because without automation, you know, you create some regulations and you must hope that the entities that are licensed to do the operations that they're going to do are going to comply with those regulations. But if you automate those regulations in a smart contract, you know, you don't need this reliance on some other entity, right? So yeah, I think there's a lot of potential, you know, for algorithmic stablecoins and even algorithmic financial products in general, you know, to be seen positively, you know, by regulators. Yeah, and that there can be a lot of potential for cooperation with regulators, you know, so that the regulations are directly implemented and programmed in these algorithmic financial products.
Thank you.
Yeah.
Any other questions? Last call. All right. Well, this has been fantastic, thought-provoking. I'll learn a lot of stuff. I thank every single guest that we have today. And with that, I thank you all for being with us today. Thank you.
Thank you.